This is my first pass at a trading mechanics video. This is a kind of a difficult subject because it's a little bit more intricate than people are used to. It bores them quickly, and quite frankly, not too many people are willing to follow it regardless of how appealing the arguments can be, but I'm going to give it a try. What motivates me is something that I noticed years ago when I began giving workshops, seminars, I was a trading coach for about 4 years. I met too many people who were able to look at historical price charts and mark them up. So these are not newbie traders. These are either experienced or veteran traders or so-called students of the market. And they would look at a historical chart and explain price movement, price swings in different disciplines. It could be Elliott wave, Gann, financial astrology, market profile, charting methods, technical indicators. I met people who 5 or 6 different ways could mark up a historical chart. But when it came time to trade, not much happened. In other words, they couldn't really forecast or predict or know when to enter a trade or how to handle a trade. So by the time I started being a trading coach, I already had over 15 years trading experience. So I kind of knew, well, these people aren't well versed in what I call trading mechanics. Your second clue is that you're simply not making money. Regardless of what anybody says to you, regardless of what your brain, your habits say to you, regardless of what you read, regardless of anything, ultimately, you have to understand that if you're not making money, something's wrong with your trading approach. I'm going to talk about a couple of what I call universal trading laws right before I begin. These are unique to me. I came up with these on my own. You might not agree with them, but I want to share them with you because I think if you spend a little time thinking about them, you might see how I came up with them. This is something I learned from years of experience by meeting literally hundreds of traders. I used to do workshops. I've been trading for over 25 years. Practically all my friends are traders. The longer you've studied trading methods without actually trading, the less likely you are to be profitable. That may seem counterintuitive, but in point of fact, let's say you had your choice of surgery and both people had 20 years experience. One had medical school internship taking up 7 years and 13 years of in-the-field surgical experience, and the other one, who had 20 years experience, had 20 years of book study. And you were going to be his first patient. Need I continue? Analysis paralysis is what happens if you know too much but don't have trading experience and are not well versed in trading mechanics. Pride in your knowledge will keep you in losing trades too long. I mean, my God, I don't know how many times I've seen that with other people. And nothing about what I've met and talked to with people, no one has a very clear understanding of taking profits. Usually you get this silly grin and that idiotic adage, like take care of your losses and profits will take care of themselves. I don't think so. That's just not the way it works in the real world. Second universal law, this is maybe will make more sense to you than the first one. What you're really trading is probabilities and what you're managing is risk. The probabilities change whenever, so your core concern is risk. If you don't know what I mean by the probabilities will change whenever, I have this video called Randomness, and that's pretty much all it's about, that probabilities come and go, correlations come and go. And this may sound a little crude, a little cruel, but all that stuff being, whether it's wave counts, technical indicators, various forms of drawing techniques, lines, wavy lines, straight lines, all that stuff's there to help you, but they don't have a reality. They don't have the reality that you assign to them. Now, the video I made called Randomness goes into that, so I don't want to spend too much time on it here. But what I do want to start with, this is a very good place to start with talking about trading mechanics, is can you write down, not describe in a general way, but can you write down clearly what trade setups you use? I mean, unless you're using a 100% mechanical software-driven system, you're in the realm of being a discretionary trader. Can you write down what trade setups you use? After you receive a trading signal, how do you enter a trade? Where do you set your initial stop loss? When and how do you change it? Are you using a profit objective or a trailing stop or both? Now, again, I'm kind of crude, but here I go. If you can't answer this clearly, are you willing, or when will you be willing to admit that you're not serious about trading? And you may think I'm being sarcastic. I am not. Let me tell you why I sound so blunt, why I sound a little bit crude, why I sound like I was born and raised in New York, which I was. But the truth of the matter is, this is what I see in the real world. I have met far more trading casualties than I've met trading successes. I've trained over 150 traders as a trading coach. Only a handful are successful, and it's not because I'm a bad trading coach. It's because these people don't know how to manage a trade. I have met people who have gone bankrupt several times. One person, again, this is only a case of one, but bankrupt 4 times, and he's coming back. He's saving money for a 5th. I have met numerous people who've blown their accounts 100% twice, and they're coming back for a 3rd time. I don't know whether they're gambling addicts or they got some kind of psychological problem, but I can tell you, and any other trading coach, anybody who does workshops with people who actually trade can tell you that more people lose money than make money, and they're not all dumb. A lot of them are knowledgeable when it comes to trading techniques. So if you think I'm being crude, there's a reason for it. Third and final universal law, and possibly one of the more, maybe the most important one. The stress of trading will cause you to change your behavior undesirably. Let's say you think, well, you know, he doesn't really talk the way I like to hear people talk, but there's some sense here. And I agree with them, and I'm willing to admit that there's more to trading mechanics, managing a trade, than just setting a stop loss. There just possibly might be more to it. Here's the problem. Once you start learning trading mechanics, once you begin to understand what a trade setup is all about, when you actually start trading, your stress level rises. And once your stress level rises high enough, you become a different person. Now, this third universal law is going to get its own video, because this issue right here is the final roadblock you have. See, most of the people I talk to, they don't need to learn more trading techniques. They've learned more than enough. This one right here, and learning trading mechanics, you're talking you can learn them in a half an hour, and then it only takes a few weeks such that you can deploy them automatically. This is not rocket science. But what is difficult is managing yourself. Because when your stress level rises, and it rises enough, you become a different person. I don't want to spend too much time on this, but let me briefly say that, you know, during the course of a trading day, you may talk to your girlfriend or wife, you may talk to your kids, you may talk to your friends, you may talk to mom and dad. And in each of those instances, an interesting thing happens. Your body language changes, the tone of your voice changes, the type of grammar you're using changes. And it happens automatically. So you're thinking, I'm this one stable core individual, but in point of fact, you have multiple personalities. I'm not saying you got multiple personality disorder. No, you're probably not a schizophrenic. But you have to understand, in the course of a regular day, you change personalities several times automatically on the fly. You have a trading personality. And that trading personality is one thing when the markets are closed or you don't have a trade on. But once you put a trade on, you got money on the line, you got some pride on the line, you have your storehouse of knowledge, pride in your knowledge on the line. It doesn't take much stress for you to change your personality. And once that changes, your thinking changes. How many times have you done this or heard other traders say, I knew I shouldn't have done it, but I did it anyway. I knew better, but I did it anyway. This is it. Well, as you can see, this is a short video, not anymore. Look how much I've gabbed already. You see that? I'm assuming you're ready. The assumptions I'm making, you already have a trade plan. I truly hope you have a trade plan. I'll just be giving some basic techniques for retail day traders and swing traders. But again, this is, I'm not going to be like, this is not what I would write a book about. I'm just going to give you a summary. But it should be enough. You may not like to hear this. This is why it's highlighted. Most all traders need to get beaten up by the markets a few times before they make the important switch from learning more and more trading techniques to learning how to trade. You may think learning how to trade means learning more and better trading techniques. I don't think so. So we'll start with trade entry. Trade entry is primarily about increasing your winning percentage by not getting filled on potential losers, secondarily minimizing your stop loss. You know what? I really don't feel like reading all this at you. You can certainly pause the video. I think I wrote this clear enough so it's understandable. You can just pause the video and read this, but I'll show you what I call my, let me switch here. I want to start actually with this and work my way back, and we'll look at some of these slides here. There's one thing I do every day, and that's day trade crude oil. And here's one, I have one golden rule I never ever break. If I have a series, this is a 2-minute chart of crude oil. If I have a series and a downswing where every single bar has a lower high, I will never buy until that pattern's broken, regardless of what I got down here. So in this case, let's say I had a magical buy signal right there. I ain't gonna buy till here till the pattern's broken. And this saves me so much bullshit. Oh my God, down through the years, you're probably looking at over $100,000 in losses. This has saved me. Because every single day, this keeps me out of a bad trade. Regardless of how, you were thinking, well, Yuri, maybe you need to learn better trading techniques. I don't think that's it. And you can see it practically on any chart that you look at. A series of higher lows in an upswing, lower highs in a downswing. If you simply have the patience to wait for that pattern to be broken, you've already accomplished something big in terms of trade entry. Now let's get back to the presentation. Early entry, contra trend. This is kind of risky. I don't do this anymore, but I used to do it a hell of a lot. You can see I recommend it. I just don't do it, maybe because I'm an old man now, and I like to keep my stress level low. But I don't trade at exact tops or bottoms. I wait for price confirmation, the second technique. But let me show you what this is about. This is, for example, this early entry contra trend. This is how Larry Pesavento traded for many years, and God only knows. I hate to say this, but that man's lost a lot of fucking money. Oh my God! But anyway, and he's a good guy, and he makes money too. But holy shit, does he lose money? Let's say you got a support resistance level formed by prior market highs, or this could be a Fibonacci line, whatever. You got former pivots here, and you drew this line here. And what you're doing is you want to sell this resistance level. What you want to do is you don't want to wait for price confirmation. You want to sell right at that level. You have the smallest possible stop loss, and you got the potential for the largest profit. But this will also give you the lowest winning percentage because you're going to have a lot of small stops hit, small losses. So each individual stop loss is going to be small, but you're going to get them hit more often. So this is fine if you're really good at picking swing tops and swing bottoms. and you're good at setting those small stop losses. No question about it. You got the potential for the largest profit, and you definitely have the smallest stop loss, but you probably will end up with the lowest winning percentage of all the entry techniques. Let's look at the next entry rule, price confirmation. I talked about that when I showed you the Fibonacci Trader crude oil 2-minute chart. Let price movement confirm your anticipated direction. When picking swing tops or bottom, let price move in your anticipated direction first. Okay, let's look at the example of that one. So market goes up, for whatever reason, I have a sell signal here, support, resistance. You're using some kind of a timing system, financial astrology, Fibonacci timing, whatever. You got a sell signal here. You don't wait until you have a bar that takes out the low of the prior bar. So there's your fill. This has got a higher winning percentage, very high winning percentage if you know what you're doing. You got only a slightly smaller profit potential. You have, unfortunately, a larger stop loss. Okay? But for most traders, this is what you want to do. You want to wait for price to confirm your trading signal. Now, entry rule number 3 is really only for trading professionals. This is a little bit more difficult. It's hard to describe in writing, so we'll look at a picture. It's you wait for price to move in your direction, just like price confirmation, but then you want to wait for a retrace. If you're familiar with the Gartley, this is kind of like the Gartley. See example, basically price has reversed in your direction as anticipated, but you have to wait for the first correction to the new swing to enter. You miss a few trades as the correction may never happen, but you end up with a high winning percentage. I got a buddy, works in Chicago. He's retired now. He's retired from, used to be a T-bond trader in the pits. And when he retired, he started trading his methodology. And on a one contract basis, he would make $70,000 a year on an average. Right now, people will look at $70,000. I make more than that on my day job. Well, one contract basis. Maybe you should trade 4, you stupid idiot. But anyway, the bottom line is that most people didn't like his technique because it was too conservative. Most people lose money trading. There might be a correlation here. Let's look at how this technique works. Here's your sell signal. Price confirms your sell signal. You're still not in the market. Then you wait for the first pullback and pivot to form. When that pivot forms, you enter the trade. Well, what if this never happens? See, here's something I know. Market only make V-tops or V-bottoms rarely. It don't happen often. Most of the time they make a top, there's a retrace, and then the actual swing occurs. That's the reversal to this swing up. So because V-tops happen rarely, you will miss a few trades, but not a whole lot. So that's why professionals like this. Because why the hell do I have to enter here and sit through this crap? So you wait for the pullback. See, if you're trading a daily chart, you're talking, I got a sell signal, and a week and a half to 2 weeks later I'm filled. Or if you're a day trader, I got the signal, and half an hour later I get filled. Well, yeah, that's what it means. So this is just a summary. Let's just look at this quickly. Here's my nice pitchfork. Now, this is how I used to trade about 20 years ago. A lot of pitchforks, a lot of Fibonacci time projections, a lot of Babson's action-reaction lines on a chart. That's basically what I did for years in the 1990 for about a decade. Now, here's my pitchfork. Now, I got these pivots marked. Notice that what I got here written here. Where'd this D come from? 2.62 times A to B, added to B. 1.62 from B to C, added to B. And lo and behold, both of them came due at this bar here. So that's a Fibonacci time projection. And price was at the lower pitchfork line. So that's my signal. That's my signal. So if I wanted to do an early entry, I would buy as soon as price touched that pitchfork line. If I want to wait for price confirmation, I wait for price to take out this high, and I'm filled right here. There was no pullback, so entry rule number 3 never happened. But that's basically what you're doing here. For most traders, I highly recommend number 2. You're not going to have the patience for 3. And number 3, since you have to have discipline in placing that stop loss, and well, I don't want to continue. It's just too sad. So for most people, I recommend price confirmation entry. I'll just let you read this. I'm not going to read it at you. You can pause the video and read about trade reentry. And this one here also, I mean, this is something that I still do, but if you're a newbie trader, stay away from this like it's poison. And if you are a veteran or an experienced trader, only do it if you have confidence in your discipline. It's called averaging down. Let me give you an example. Averaging down would be, let me find a place where we have a nice bit of a retracement here. Let's say I sold here. I wait for price confirmation, whatever. Market swings up and I'm selling here. Let's say market retraces, and instead of being stopped out here, I may have a Fibonacci line here, a Fibonacci level here. So I'm going to sell again. So sell number 1 was here, sell number 2 is here. So when price gets back down here, I exit the first trade out of wash, I got a profit on the second trade. Here's the problem. Some people, when they do this, they do it a 3rd time, a 4th time, and then in the course of one day, they can blow their entire trading account. You have to have discipline to do this. But that's basically what it's about. It's about having multiple support resistance levels. And when price moves against you, adding to your position at the next support or resistance level. And if price moves against you some more, you take a big loss. But most of the time, if your support resistance levels are right and the indicators and your trading system is good, a lot of the times you're at the very least going to come back to your initial entry. So this technique works pretty good. But again, you don't do it unless you really are good at your discipline. Stop loss placement, I'm not going to spend much time talking about that because quite frankly, most of the literature out there is about stop losses, whether your trading magazines, your books, your courses. Stop loss placement is easy. I will cover it. I'll show you what I do. You can stop the video and read it, but the bottom line is there's a catch-22 here. If you're a newer trader, chances are you're no longer watching this video. If you are watching this video, you're probably fighting to stay awake. Now, if you're an experienced trader and you need me to talk to you about stop loss placement, I have a catch-22 here. See, if you're an experienced trader and you're still trading without stop losses or you don't know how to set them, that means you've blown your account a few times. You have a problem which is far greater than a short video can help you with. All I can tell you is stop trading, get help, and I am so serious because I have seen this. Oh my God, have I seen this in the past 25 years that I've been trading. You don't know what you're doing to the people around you. Let's take a look at what I do or what I recommend. What I'm currently doing for stop losses is I really like the chandelier, but what I used to do for many years is I would have a formula, first with Metastock, then with E-Signal Advanced Charting. I'd simply take the advanced trading range of the par far bars, multiply by 1.2, subtract it from the low of the entry bar. That would be my initial stop loss. Every couple of bars I would raise it. I would raise it up until my time stop got hit. Time stops are described right here. Let's look at the chandelier. Here's the chandelier indicator. Let's say for whatever reason you went long someplace in here. The chandelier told you to get out of here. The chandelier is awesome in my opinion. Let's say you were short. The chandelier tells you to get out here. The chandelier some people use for entry. You know, in a wide swinging market, some people use the chandelier entry. Now, if your software package doesn't have the chandelier indicator, which you can use for stop loss placement. It's primarily trailing stop, to be honest with you. Then what I recommend is, let me do a do not show. Most software packages has the parabolic indicator. Use that. It's very similar to the chandelier. Play around with some of the settings so you get it a little closer to price. The default settings of the parabolic might keep it a little too far from price, but the parabolic is a good substitute for the chandelier when it comes to setting a stop loss. Oh, one other thing. Now, it'll be covered in profit objectives. Now, you may disagree with me. That's fine. I just want to present my point of view. The very hardest thing to do in trading is setting profit objectives. See, here's the thing. Stop loss placement is ridiculously easy. It's hard to do emotionally, understand, but it's easy. Trade entry, I mean, how hard is it? How hard is it to, like, okay, I got a signal. I'll wait till the high of the prior bar is exceeded before I enter. Does that sound difficult? Robert Fisher, one of the best traders I certainly ever met. God bless Robert Fisher and all of his work. But that man made a career out of just trading Fibonacci signals and buying when price exceeded the high of the prior 4 bars, selling when price exceeded the low of the prior low bars. And he did this for decades. Okay? I mean, this stuff's easy. Now, profit objectives, that's not easy. As a matter of fact, I got this line here. I believe the exact reason "take care of your losses and your profits will take care of themselves" is popular is because it's a cop-out, because no one knows. I mean, you're off your rocker. You know, you're basically proving to yourself that either you're not a trader, or you're not an active trader, or you're just a so-called student of the market if you think all you got to do is take care of your entry signal, set a stop loss, and everything else will be hunky-dory. I don't think so. The number one thing, obviously, let's just get this out of the way. Obviously, if you're long and you get a short trade set up, obviously, you just hit your profit objective. It's time to stop and reverse. Now, this line here, I can't stress this enough. You really need to trade multiple contracts. For example, if you're trading crude oil like I am, and you're not capitalized enough to trade the full contract, then you trade the crude oil mini, and you trade 2 contracts at a time. It's just this will make you so much more money at the end of every month if you're a day trader, at the end of every year if you're a swing trader. Now, again, I don't feel comfortable reading this at you, so you can just pause the video. I mean, it's self. You don't really need me to. Just pause the video and read it. But what I can share with you, let's get the parabolic out of the way, is for initial stops, what I like to do. So where's an example? Let's take for example over here. Let me do a Fibonacci expansion. Oh, that worked really well. Let's try that again. There we go. And I draw 2 of them. And if you didn't see what I'm doing, you could just rewind the video and see it. Okay, so normally what I'll be doing is if I'm long and the trade's profitable, I'll be getting out at one of these fib levels here. Okay. Usually when I see a double this close, it acts like a magnet for prices. All right. It's kind of like if you're familiar with my planetary line work, same concept. And then I use a trailing stop for the second part of the contract. Now sometimes that means the market will retrace and I'll get out at a worse stop than before, but a lot of times, oh great, show, yeah. What'll happen is, I may get long here on the breakout, 1 tick above that bar if I got a buy signal, and I'll take my profit here. Now, probably I would have been stopped out here for pretty much where I entered the trade, but let's assume that this didn't happen. I'll be getting out with this chandelier. I don't know if you can see that. That'll be my trailing stop. So you can modify this, but you got to take this stuff seriously. But this is what I found works for me. The first half of my position, get out at a support resistance level. And then with the second half, use a chandelier, a parabolic, or whatever else you want to try to ride the market up as far as it's going to go. Maybe a third of the time you're going to end up with the second half of your position getting out pretty much where you entered the trade initially. So why bother with this? Because every now and then, especially if you're trading something like crude oil or the Russell Mini, it's just going to seriously extend. And you may have made, let's say, 150 to 200 on your first trade, the first half, and you're making 6, 7, 800 on the second half. And that's what this is about. Because with a market like crude oil, that's going to happen a couple of times a day. Well, if you have any questions about this, there's my email. Again, I don't have a lot of confidence that too many people can watch a video like this and actually do something with it, because I'm going to get back over here. This is real. This is what I've seen for 25 years. So if you're a student of the market, I can even tell you what you're going to do. You're going to start trading eventually. You're going to lose a lot of money, and then you're going to go back and try to learn more entry techniques. I'd recommend you don't do that. You know more than enough entry techniques. You know more than enough trading methodologies. Learn how to trade. Learning how to trade is this stuff. All right?